this, let's bring in our next guest who says the banking crisis has made mortgage-backed securities market worse. Logan Mohtashami is the housing analyst from HousingWire. He joins us now. So, Logan, just put some of the housing data we were talking about with Diana and whether we are seeing enough disinflation to make the Fed satisfied here, because shelter has been a big problem. What do you think?
I don't believe the Fed is going to be satisfied until they see the labor market break, which means jobless claims are going to break much higher than they are today. But the mortgage-backed security market spreads have gotten worse since the banking crisis. Mortgage rates should be lower than they are today, but the housing market has really kind of stabilized November 9th of last year when rates started to fall from 7.37% down to 6%. We've been kind of back and forth. So we've seen stabilization in that front, but the Fed is basically bent on kind of making the labor market break. So that is their disinflation weapon at this point.
I guess I was specifically asking about housing, though, because if housing prices go to 0% growth, that would do a lot, wouldn't it, for core CPI and an overall inflation?
Not really. If you look at core PCE during the housing bubble years when we had tons of home price growth, it was basically at the Fed target level. It's really rent inflation, and rent inflation has been cooling down now for some time. It's going to lag the CPI data. So home prices itself does not really push rent inflation up. So those are two different categories. Just for housing, over time, in about 12 months, the growth rate of rent will make that CPI data much lower. It doesn't impact the PCE data as much as the Fed's 2% target, but the Fed needs to just kind of endure this inflationary period and try not to create a job loss recession to get their 2%. And I think everyone will be more happy with that outcome than just pushing rate hikes and waiting for something to break and credit getting tighter and people losing jobs. That's not the most effective way to get through their inflationary targets.
Logan, a lot of discussion yesterday about Case-Shiller and the cities in the top 20 that are negative year on year. San Francisco, Seattle, San Diego, and Portland. And the Journal did that great map about markets basically west of Colorado negative and east of Colorado still positive. I just wondered if you think this can be contained to the western quarter of the United States.
Total active listings are near all-time lows. New listings data is negative year over year. So the areas that have the highest housing inflation growth are going to get hit price-wise, but definitely nothing like what we saw from 2006 to 2007, where we saw a mass supply of inventory everywhere due to distressed sales. So, yeah, it can be contained as long as you don't have a really bad job loss recession, and the job loss recession lasts a very long time. Definitely, we only see the really big housing hits on areas that really took off on home prices in a very short amount of time. Everywhere else is somewhat stable, and I think that's a good thing. That shows that the credit channels after 2010 have worked, and people are just staying in their homes and living in their homes longer and longer. That's a positive. So we can fight inflation without creating a massive job loss recession or housing looking anything like what we saw from the 2008 to 2011 period.
Logan, thanks for weighing in today. Appreciate it with some of that new data.